So today we're going to talk about the startup and ongoing costs of starting a business. I think a lot of people kind of always want to know how much it's going to cost for me to start this.
Yeah.
You know, what am I up for? Today we'll sort of break it down, look at the startup costs, ongoing costs, and then also some ones that you wouldn't really expect that might catch you off guard if you didn't really know.
Yeah, that's right. So, I mean, setup costs are probably the main one that people will come across. So, if you're setting up a company, you're going to have ASIC fees, accounting fees if you engage an accountant to help you with that. And then, depending on what other structure you go with, there'll be costs involved with that. You're going to have the initial costs that you might have for any inventory if you're a product-based business. So before you can even launch the website, for example, or if you're in a store, you're going to have things to put in the store or on the website. So you're going to have those initial product costs. If you're a service-based entity, not so much. You probably just have to have some subscriptions and things, which we'll talk about more. But it'd be the downtime that you don't have working at your day-to-day job if you're going out and trying to start something up. So.
Yeah. For sure.
And then a buffer for probably unexpected costs. So, if there's anything that comes up along the way, like a shareholders agreement or something like that, that's going to be an extra cost, like having a bit of put away for that. So, I mean, in terms of a dollar cost, God, it could range, right?
Yeah. Definitely depending on what industry you're in and sort of what products you're selling. If your inventory is quite cheap, it might not be so bad, but if your inventory is quite expensive, for example, like a car dealership.
Well, that's right. And I had a good conversation the other day with someone that, so they've got a car dealership and one of our clients has a car retailing business, and the capital involved for that is hundreds of thousands of dollars just to have a few cars on the lot, right? So compare that to someone that's doing, gift boxes. The startup costs are vastly different. So having that access to capital, and then that becomes an opportunity cost, right? Because if you're putting $500,000 into holding cars, that's $500,000 you're not having in savings or in a house or whatever, right? So
and that's massive. And especially the difference between a product-based and a service-based company, whereas a service-based wouldn't need those things. It might need a laptop and maybe some subscriptions, but again, it's the capital needed isn't that much. So
that's right.
Can range, but obviously that's something to look out for when you're starting up a business and some things you'll need to calculate.
Yeah, that's right. And one of the things you want to do before going into business is prepare a budget. And so you should get a good idea of what those items are before you even take that first step. But those are some of the first initial startup costs. In terms of ongoing costs, what are the main ones that people should look out for?
So I guess if you have employees, the big one is obviously going to be their wages and salaries. If you're a product-based company or business, you'll need, in the accounting world, they're called cost of goods sold, but that's pretty much just your products, right? So they're called cost of goods sold because that's the cost of them before selling them on. It can be raw materials as well. You'll also be looking at accounting fees, just the setup costs, and then ongoing will be compliance work, so activity statements, tax returns, things like that. Subscriptions as well, so obviously depends on what industry you're in. You might need more subscriptions, some less. And accounting software, which is quite important coming from us.
Definitely recommend that.
It's just a good thing to have to be able to track your finances. Being able to track what's coming in, what's coming out is really important for a business owner, just to make sure you have good cash flow and can keep the business running profitably. Depending on the business as well, website hosting, even if a construction company will probably need a quoting software that's relevant to the industry, whereas a different company, for example, a law firm, wouldn't use that, but it would use something different. So those subscriptions will vary from company to company, but they are quite important. What other ones do you think?
I think going back to the cost of goods sold and the wages, so service-based businesses, generally their biggest cost will be salary and wages because it's a service business, so it's usually the people providing the service, versus the product businesses, which are you're getting inventory, you're building up that cost. So there's a big difference there in terms of how much capital you need to invest, because the product businesses, you have to buy all that and it sits there. And so depending how quickly you can turn your inventory is how quick your cash conversion cycle will be. Compared to a service business like ours, where usually you'll bill a bit up front, do the project, bill the rest of it. So your cash conversion is usually, part and parcel with the provision of the service. So it's a good thing to keep in mind, because a lot of product businesses, like, they do well, but because they're growing, they're constantly investing in their inventory. So they never see the results, right? Until like a few years in and they're stabilized. But whatever your startup to probably 1 to 3 years maybe in a product business, if you're seeing that growth, then you're going to be constantly investing more inventory, more systems, maybe a bigger warehouse, and you don't actually see that bottom line kick out until you like stabilize. So into something to be aware of, compared to the service business, where yes, you might have to put on more people, but generally you'll see that return a little bit quicker. So.
So I guess with the cash conversion cycle, would you be able to explain that a bit for people who don't understand? Just because,
a lot of people probably, don't. So look, what I mean by that is just basically your cash flow. So like how quickly you turn your accounts receivable, your inventory into cash. So when you go and buy something, product, if you buy it up front, well, then that's cash straight out the door. If you buy it on credit, then you've still got the product, but you haven't paid for it yet. So that would help your cash flow, because you don't have cash out straight away. On the reverse, when you make a sale, if it's an online sale, then usually you'll get the cash straight away, or maybe a few days for clearing. But if it goes to accounts receivable and they don't pay for 30 days later, your cash conversion cycle is, okay, well, I've sold the product. 30 days later, I get paid. So it takes you 30 days to collect it. And then if you've already paid for stuff beforehand, you just go into a negative cash flow. So the cash conversion cycle is essentially, how quick do I pay people? How quick do I get paid? And with inventory, how quick do I move the inventory? So,
And it's something that can be overlooked, right? Because
very much so.
A lot of people might not understand how that works if they're not in this space or they've never started a business. But there is some time in between purchasing the materials or purchasing the products and actually receiving the cash for it, which, like you said, can affect cash flow.
I actually had the question from a client today about why are we making a profit, but we're using an overdraft to fund the business. So it's very topical, but, and the explanation to them was that, you've got either assets that you've invested in, or you've capitalized inventory that you haven't sold yet, and accounts receivable that hasn't been collected. So the cash isn't there, hence they're using their overdraft, but the business is profitable. So it's just a mismatch in the timing.
And that's just, you'll understand that the further you go on and the more you understand how profit and loss and balance sheets work, which we'll go into, and how to explaining how what they mean, what's profit, what's the bottom line, what's the top line, stuff like that. You'll need to get your head around to be able to understand how the business works, and that's how you'll be able to figure out how to forecast your cash flow, or figure out where the cash is going, or you're receiving money but it feels like you're constantly running at a loss, or you're not making enough money. It's usually because of that, right? Because you don't have a good understanding of where it's going.
Yeah, that's right. And look, if you're in that situation, just ask your accountant to explain, can we go through a cash flow?
100%.
And just go through that statement of cash flow, and it should, over time, you'll get used to it, right? But don't, be too upset if you're not unsure what it is at the moment. But
and there's a lot of things to it. I mean, I still get caught up sometimes. For example, the capital account and non-capital account. For if you're buying an asset, you're not gonna it won't show on the profit and loss. You only show the depreciation. But things like that, you'll understand them as time goes on, as you have more experience in the business, how those things work. But there's also something we'll go over later on anyway. But those are just some of the usually expected ongoing costs, right? Which kind of you'd expect to be up for. But then there's also some unexpected or overlooked costs, which you may not know or may not realize until it gets to it, and you're slapped with a bill that you don't know why. And this is kind of what it is. So what are some of the main ones that we see that they kind of catch clients off guard, or catch business owners off guard?
So superannuation would be one of the main ones. So that's it'll be 12% soon. So basically, if you've got someone on 100 grand, 12%, $12,000 of super. It's just one that people sometimes forget, and obviously builds up, and then they get penalties and all sorts of trouble. So superannuation is one that you really need to keep on top of. Know that you need to pay it on time to avoid any scrutiny from the ATO and all that. GST is another big one, so 10% on your sales need to be remitted if you're registered and have to declare GST on those on sales. You do get 10% back on the products that you buy and expenses that you make if they've got GST on them. But yeah, the big one is the sales, right? So people go and make all these sales and then they don't put that 10% away.
Yeah,
So.
yeah, and then they get slapped with a GST bill and don't realize why, because obviously when you send an invoice out, 10% of that is GST.
Yeah.
Usually a good rule of thumb would be to try and transfer 10% of your sales out. It'll cover your GST and more.
Yeah.
Just because there's be some expenses. Obviously, if the company's running in a profit, then you have to pay the difference in GST there on activity statements. But again, something that can just catch some people off guard. And if you don't get on top of it early, once the next one rolls around, you get another bill. And if you don't pay them on time, you'll get fines and penalties and interest accrued on them as well. And also touch base on the superannuation, it's the same, right? So if you're not paying them on time, it'll snowball. But superannuation is also related to the employees. So if you want to make sure that your employees are happy, it's a good idea to pay their super, right? Because that's their retirement savings. If you're not paying it, then their retirement savings aren't accruing and aren't getting that compound interest. But that can really cause some issues with your employees if you're not doing that. So not only will it cause problems with the ATO because you'll get charged with penalties and interest on that, but it also can cause some problems with your employees and make them unhappy, which is not ideal, right?
Yeah, absolutely. The other main ones, POG withholding, so withholding on your employees' salary, so basically just their tax is another big one. POG installments, so usually after your first year of trading or if you elect into it beforehand, you'll have POG installments, which are just prepaying tax. So that's another one that's obviously forgotten. Insurances, that's one of the other ones that's usually forgotten.
Yeah, especially work cover. I think we've spoken about it before, but it's something that you kind of need to have, and just is again sleep of night factor, just to make sure that you are covered in case worst comes to worst, is something has happened on site or at work. That insurance will help cover that, so that you're not out of pocket. You most likely won't get sued for it. It'll help cover those things as well. So yeah, definitely something that to look into and make sure you're on top of as well.
Absolutely.
Some legal fees as well, depending again on what industry you're in. Some might have more legal compliance, where some might not, but it's important to have those in place, again, just to protect you, make sure that the work you're doing is compliant, you've got the relevant terms and conditions and things like that set, just because it's important just to protect you, protect the business and keep you going forward. Some other things will be, obviously, again, depending on what industry you're in, but repairs and maintenance. It can catch some people off guard. If you're in a truck haulage company, for example, we had one recently where they had to do like a whole rebuild. It cost them around $13,000 on it. Quite expensive, and if you're not expecting that, it can throw you off guard, because you might be running profitably, but a 13 grand bill can really screw you over, right? So,
and definitely even not like just existing businesses, like startups, for example, because they're probably going to buy that secondhand vehicle or secondhand asset, whatever it is. So that's a really good one to make sure you keep on top of.
Also chasing debtors. So what that is, depending again on what industry you're in. So some industries they pay on card, they pay right there. In other industries, you'd have things called debtors, and that's pretty much your accounts receivable, as Andy's mentioned before. So in most businesses, you'll send out an invoice. You'd sort of have a set term that needs to be paid by. For example, 7 days from when the invoice is due. Some people don't pay them on time, believe it or not, and they just let it go and go and go. And you're expecting to be receiving, for example, that 7 grand invoice next week, and it doesn't come, and now you don't have enough cash in the bank. So things like this could be an issue. It's not exactly a cost, but it's sort of losing out on that cash, because you kind of need that cash to pay your accounts payable. So your purchases, your materials, things like that. So obviously things like that can be frustrating, and also the time chasing them up. Some people just don't want to pay them. you're going to have to spend time calling them up saying, you know, hey, you're going to pay this invoice. I need to pay my employees, like stuff like that. It's important. So
I think that one's the biggest slap in the face when you go from being an employee to a business owner.
mm-hmm.
You know, you're used to getting your pay slip every week or fortnight or whatever it is.
Yeah.
And then you go out and you invoice, oh, you know, it's pay on invoice or pay in 7 days.
Mm-hmm.
And you just assume people are going to do that. But
Yeah.
they don't, because they're managing their own cash flow. So that one's huge.
Mm-hmm.
Like, just because it says it's due on the 21st does not mean they're going to pay it on the 21st.
Yeah.
Hence why we say it's so important to have that safety bucket. So
yeah, a bit of buffer, because you want a bit of cash in case that doesn't come in. You got to get cash from somewhere, right?
Absolutely.
And you know, with the cash conversion cycle again, if you're already out of pocket with the purchases and your sales, something like this comes up and it just screws you over even more. So definitely something to keep an eye out on, and just be wary that that stuff happens, and it's actually more common than you think. So
on that, just funding businesses, right? And I know we touched on it before on a previous episode, but that's why so many of these businesses are funded by, you know, drawdowns on mortgages and things like that, because they just need that extra cash to go into it. And why it is such a risky thing to do. But
100%.
ASIC fees. So if you're a company, you'll have an annual ASIC fee. Not a material expense, but still one to be aware of. Merchant fees, that's a big one, right? So, and especially when pricing your products, making sure that you factor in the merchant fees, because if you're selling through Stripe, Square, PayPal, Shopify, they're all going to have a little fee on them generally. If you're not incorporating that and a few other things, well, then your margins are going to be way out of whack. So, and we'll go into that in another episode, margins and how important they are. But merchant fees are a big one.
Especially since, I guess, depending on who the provider is, but 1.7%, you probably won't think that's a whole lot. But if you're running on thin margins, like for example, cafe industries or hospitality, that stuff can be quite significant, right? Because a lot of those industries are running on razor thin margins. You need to be wary of those. Plus, on top of that, for those industries working on weekends, that's why you'll see public holiday surcharges and things like that, because they're already running on such thin margins. And merchant fees on top of that they can vary or range from anywhere from 1% to 2%, which if not more. And you'd think that's not much, but when your average price of a coffee is like $6 and a meal is like $20, you know, and it's an extra 1-2% on top of everything, it can affect it quite a bit. So something to make sure to help make sure you get your pricing right for that as well.
That's a good point. Like, and also with regards to that, if you're doing your budget and you know, okay, well, I've got this, and then I'm going to run a discount promotion or something, but you've forgotten those, well, then, you know, you may actually be losing money. It's really important to know. Professional development. So service-based businesses, a lot would have professional development. They need to maintain their CPD, continue professional development hours. So that's the one that you need to keep in mind. Bank fees, same as the merchant fees, right? Like just little things like that you need to be aware of.
Even Amex charges.
I
mean, you do get the points, but you still get charges on them. Even paying ATO bills, you'll get charged on them. So sometimes you have to see if it's really worth it, if the actual cost of those charges outweigh the points that you get. If you're paying large bills for the ATO, for ATO debts, the charges on them can be pretty significant. And over a long time, I mean, you do get points for them, but is it worth the 11 grand in bank charges at the end of the year? It's kind of tossing that up, right?
You'd have to go to one of those Point Hacks websites or something to figure it out, right?
To really make sure, is it 11 grand or is it flights to Europe? Who knows if it's really worth it. But definitely something to keep in mind.
So look, I guess what the main things that people can take away is, you know, do your budget up front. Use the internet as a great resource, ChatGPT, any other AI that can help you budget for your particular business. Have an emergency fund, and should they work with their accountant from the get-go, or wait till they've developed a budget?
I do think it's a good idea to get in touch with an accountant early, just because they can also help guide you through this process. They'll let you know what those expenses are going to be. They can help you set up a budget, so at least you're not running in blind, especially if it's your first time setting up a business. They always say the first time setting up a business is one of the hardest things, right? After that, you'll learn from your old one. But for your first one, it's good to get some advice and help from someone who's done it before. They can help you set up the budget, like you said, and that'll help you figure out how much money you need to make to cover your costs,
Yeah.
if it's even going to be running at a profit, if it's viable,
Yeah.
and sort of how to help price all your products or your services, right?
Yeah, yeah. And I think if you come with some good resources like a draft budget and maybe some product costing and things like that, and even if you're not comfortable with that, just do the budget or whatever. But a couple hours of their time and you'll get so much value from it. So I think it's well worth the couple $100 or $1,000 that it'll be to do that. So.
Yeah. And it's definitely early on, the earlier the better, because you don't want to be in the other boat, right, where you've started your business, it's not going well, and now you need to restructure everything. You might have to restructure your whole pricing strategy, and then from that your website, if you have a website, for example, and then start again from the start, where you could have just saved that time and those costs and done it earlier.
And that's it. You don't want to be that person in the news that's launched a website, realize they've actually done everything wrong and the prices are wrong, and have to just renege on all the orders or whatever.
And hike up all their prices. So you don't want to be that guy or that girl. So.
Absolutely not. So yeah, look, hopefully that's some good value for everyone to take home.
Yeah, absolutely.